Hello and welcome to the Q4 Global Market Update with myself, Paul Kelly, Director here at Astute Private Wealth, and Dr. Scott Osborne from Astute Investment Management. Scott, I'm going to start today off by asking you about a potential bubble in global stock markets. A lot of commentary at the moment in the press. What are your views on a potential bubble heading our way?
Yeah, it's bubble's certainly the word on everybody's lips at the moment, isn't it, I think? And actually it seems to have cut through. It's the most widely regarded bubble in history, probably. So I think that in itself is almost a sort of caution around it. If everyone's expecting the bubble, if everyone's kind of agreeing that it is one, and maybe it's not quite as typical as previous ones. But certainly you can't argue the fact that the valuations are stretched versus history, and that there's all these kind of classic bubble indicators in terms of concentration and new format technology. You know, all these things that have traditionally lined up to build bubbles in the past. Now, my main point here is, before people start worrying about a bubble, is that it doesn't really matter. And I know that might sound strange, but you know, when we look back through our history, our strategic model, as we call it, has all the previous bubbles in it. So we, in our model, you know, our base case starting place in 1999, our model took the dot-com bubble full in the face and still made money over 10 years, you know, and that's the starting point to say that is why we have these minimum investment time horizons. We say to people is it's because we know markets generally do go through these cycles, and that's why when you invest you need to have that time horizon. Having said all of that, obviously we actively manage the funds, and we have taken steps over the course of the last year and before to mitigate where we think there is significant risk, particularly in those high value tech stocks, and you know, slightly moving away from them. But they have driven the market a lot, and when there's a new format technology, which is most of it's linked to AI, you know, it's very easy to paint a picture where there is a completely different world, and they get an outsized share of all that earnings and all that sort of value that's generated from that, and actually they are worth, you know, the kind of valuations that people are paying for them. So it's not very clear. I would make a couple of final points just on the bubble sort of fear. It is clearly different from, say, 1999, because the companies that are inflating this bubble are very high quality companies. They're not going to go out of business if the AI sort of thematics falls flat on its face. They're not going to disappear. They're just going to have wasted a lot of money, basically. And there's not a massive distinction if, you know, if you're a dot-com stock in 1999 and your valuation is this high and actually you don't earn that much money. Well, that's not real different to a very good company today on a very high valuation that doesn't earn money. It's the same thing. But at the end of the day, the business isn't going to disappear, which a lot of dot-com bonds did, essentially. And that brings me to the second point, which is if you are sort of bearish on this, if you're not really buying the whole AI, and we're kind of semi in that camp, we think it's a general purpose technology, it will change things, but we think it's probably you know, not as much as what's in valuations. Even if that's the case and it all does fall flat, these businesses have been generating so much cash that they have essentially just been using their own earnings to fund this. You know, the sort of 5 trillion or whatever it's going to be that's invested in data centers in the US has almost entirely at this point come from money that they've earned. If they start borrowing money, if you start investing other people's money, or you start leveraging up that money, that's when you have a bigger problem. That's what happened in the global financial crisis. You know, it's fine if you take money and throw it on a bonfire. If it's your money, if it's other people's money, you know, we have a bigger issue. So that's the other thing that's kind of provides a little bit of security. We are starting to see some borrowing and bonds issued in order to fund this, and that's when you might get a little bit sort of more wary that a, you know, collapse or deflating of that bubble could actually affect other areas. But for us at the moment, even though we don't necessarily like that area because of valuations, we don't think a bubble popping necessarily would have huge, you know, long-standing market consequences, kind of like a global financial crisis, or to a lesser degree, dot-com bubble. So yes, it probably is a bubble as far as I'm concerned. Should you worry about that? No, not really. You know, let us do the worrying for you. We've got things in the portfolio that are managing that risk. And at least at the time being, we don't think it's this material systemic risk, even if it does pop. So yeah, there's a lot of sort of noise around it, but it's very much within our thinking, and you know, the markets are kind of will land where they land based on how this AI theme actually plays out.
Okay, Scott, the question which comes up a number of times with clients at the moment is about tariffs and trade wars. We saw a lot of volatility in the market in March and April. Has this subject gone away?
Yes and no. Some has been settled, right? There's been trade deals with the EU, trade deals with sort of Canada, Mexico to a certain degree, and lots of other sort of smaller nations have kind of basically succumbed to US pressure. The place where there's two areas where there's still uncertainty, and uncertainty was the big theme for us around this because you have no idea what's going to happen. One is China. Clearly China stood up, pushed back on the rare earths and sort of critical minerals. They started to deny the US access to these critical components for high-tech stuff, and the US had to come to the table. And that means that they've kind of met each other as equals to a certain degree. That means tariff rates have come down from the really high ones, but it's only a matter of time, as you said, to that probably bubbles up again in some other area, because we'd kind of reached an agreement earlier in the year, and then the US changed some of the rules, and China once again put tariffs, and so it will almost certainly come back. The other big uncertainty around this is currently the court case in the US. So the Supreme Court is assessing whether Donald Trump could legally actually use the sort of mechanism he decided to use, which is like emergency powers, in order to enforce tariffs, which always looked a little bit suspect, really. And if that's overturned, then the White House will have to find another way to kind of reimpose those tariffs, and that will create a lot of uncertainty as well. Principally because they've done a big budget, which is quite a fiscal loosening, and those tariff revenues do add up to about 1% of GDP, and that's an additional hole in the budget if they don't put those tariffs back on. So it kind of has gone away into a certain degree, probably in the complacency camp now, because these other issues will bubble up, but they still firmly sit in this completely uncertainty camp for us. It's not like it clearly is a risk, but it's so uncertain that it's not clear how you would accurately manage that risk. So really you've got to look at types of investments that just hedge against uncertainty itself in a kind of amorphous sense, rather than a specific, okay, well, China's going to do this, so we are going to position this way. It's much more like, we don't know what's going to happen, so let's take less risk, or let's take a risk of a certain nature. But you're right to say that this almost certainly will bubble up again in the near future, and probably into next year and further into the administration too. We'll just have to live with it and react as and when developments occur.
Okay, Scott, we're approaching November the 26th, the budget date. Lots of meetings around this subject at this moment in time. Do you see the budget affecting markets in any way?
Yeah, obviously this is a big issue. I spend a lot of time thinking about different tax policy and stuff. Obviously, the first thing to say is the most important impacts from this will be on financial planning, and obviously we will produce materials, and there'll be a video of our reaction to the budget from a financial planning perspective. It's probably more important that most people, look at it from that perspective. Certainly our clients. In terms of markets, yes, it is important and it isn't important. The major thing, the make or break for markets in this will just be the fiscal credibility. They got the budget wrong probably last year in terms of the measures they used. They avoided raising big taxes, and they probably shouldn't have done that. So the market really wants to see two things. One, sufficient headroom, i.e. they have to raise enough money to not be in this situation again in a year's time. And they have to show that they can actually reduce spending in some way, because it can't all just be tax raising, because obviously that will effectively impinge on growth. So if they do this big credible budget, it would be politically very painful for them. It might even cost Keir Starmer his leadership if he doesn't go anyway. The markets would probably be quite happy with that. If you see salami slicing and sort of policy for the sake of gaming the system and the OBR forecast and all that sort of nonsense, the market won't like that. And the principal place you'll see a reaction here is in government borrowing costs, so gilt yields. And bear in mind, as a as a sort of baseline gilt investor, the best scenario is that the UK economy goes into a massive recession, because gilt yields will be interest rates would be cut very sharply and gilt yields would fall. So if you see gilt yields fall rapidly after the budget, that's not necessarily a good outcome. But yeah, that's the one place that we'll basically be looking for policy, and that's where we'll see the impact of the market in borrowing costs.
Thanks, Scott. Our final question today will be looking at portfolio positioning. I understand there's been quite a lot of movement in the portfolio this year. Can you talk to us in a little bit more detail about what you guys have been up to?
Yeah, I mean, obviously some of the things that, and in previous videos we kind of mentioned, we have broadly been de-risking this year. It feeds into the first question about valuations being stretched and so on and so forth, where we see things that don't look worth it over a kind of very long time horizons, we're reducing our exposure. But in the grand scheme of things, we're about neutral on equity. So, you know, this is our base case, basically how we are. We think things are okay, but we're underweight certain areas like the large cap tech stuff in the US where we think valuations are a little bit stretched. The whole uncertainty debate around Trump just generally, but tariffs specifically, has led us into certain products where we can basically turn expectations of volatility into income. That's a bit sort of abstract, but basically what we're doing is the kind of things where we generate an income from a physical asset. So we did some real asset investments earlier in the year. We're now looking at what we call structured products, where we literally do make a deal with a bank and say, okay, well, if markets go this way, we'll make this level of return. That's why we call them structured products. But on those sorts of things, you can kind of say, okay, well, markets may carry on and do really well, but we're willing to swap that potential upside for a fixed level of return. And you can, because of volatility, because the possible range of outcomes for markets is quite high at the moment, we can get pretty good fixed returns on those, like very high single-digit returns. So we're putting some money to work in those, and it's this case of if it is a bubble and it keeps inflating, for example, that's not our base case, but if it is, then we might underperform the market slightly, but we'll still be making double-digit returns probably. And if the market crashes because it is a big bubble and it all goes terribly, well, sure, we'll get some of that exposure, but we'll also be clipping these 9-10% coupons on these types of investments in the process anyway, and we can take that money and put it to work in equity markets at much better valuations. So those two themes about a sort of broad de-risking and managing uncertainty of the portfolio have been throughout everything we've done this year, and it's just been about finding the right kind of products to express that view, basically. And like I say, real assets, structured products, these are the kind of things that we've spent a lot of time on and bringing into the portfolio over the course of the year.
Okay, thank you, Scott. That's been a really useful session. That's all we've now got time for today. If you do have the benefits of working with Astute, please contact your normal financial planner for further information. We're just about to launch our budget video at the back end of November, so please watch out for that video and don't forget to press that subscribe button for future videos. Thank you very much indeed.